to BDO's 2017 budget analysis. My name is Peter Harrop and I'm a tax partner with BDO and I'm host for today. I'll present today with Phil Hall, a fellow tax partner, Karen Foster, a director in human capital. Before I get started, there is some housekeeping I'd like to cover. The webinar is being recorded and will be posted on the BDO YouTube channel shortly after the presentation. All of these lines have been muted, but if you want to ask any questions, there's a Q&A box on the right of the screen. We will try to cover some questions during the presentation, but we will respond to all questions raised afterwards. If you have audio problems, please ensure the computer volume is turned up. If you wish to use the dialing, click on the phone icon on the right-hand side to listen through the phone. I think we go. You'll see that we're covering personal taxes, business taxes, etc. And we'll work our way through those over the next hour. I wasn't quite sure what to expect from Philip Hammond's first budget speech, particularly his nickname of Spreadsheet Phil did refer to, but I thought he presented well and I enjoyed the jokes. Perhaps you could say he excelled. He was a boy with some good news. 2017 growth figures came in at 2%, which was above the 1.4 it was projected in the autumn. At a record high, and net borrowings are down £16.4 billion from where they were expecting, together with growth in 2016, which was second only to Germany, did present a good picture. To say that inflation is projected to be 2.4% for 2017, but going down to 2% for 2019. GDP figures, a bit of a fall for 2018 to 1.6 and then picking up again in 2020. That he delivered was the deficit is down, but debt as a nation is up at 1.7 trillion, which is quite frightening, really, isn't it? £70 billion of interest being paid on an annual basis. Employment is up, but unfortunately production seems to be sticky and just is lower than we'd like it to be. Too many young people leaving education without necessary skills, and we'll touch on later. Want to support public services, and he put £2 billion aside for that. Wants some help for ordinary working families, and thinks a strong economy needs a fair, stable and competitive tax system. Great hope that will underpin our future, and that's the bit we'd like to concentrate on today, so we're looking for changes in the tax system. With that in mind, I'll pass over to Karen, who will cover the personal tax.
Thank you, Pete. I'll start with a look at the income taxes and rates and allowances and the roadmap, really, to get us to this 50,000 threshold for individuals that are liable to higher rate tax. And that the impact there of the new Scottish rate means that they're falling slightly behind there, really, on that progress to 2020 and 50,000. The tax rates and allowances in a bit more detail. There's nothing really to get too sort of excited about, other than the proposed change from April 18, which reduces the dividend allowance from £5,000 to £2,000. Minor changes otherwise to the rate bands for 27/18. Income allowances. These allowances come in again from April 17. Whether or not they're beneficial to you might depend on the level of expenses, but one revision to the proposals that was mentioned in the budget prevents the allowance from applying in certain circumstances where you're a participator in a closed company or a partner in a partnership. For a while now is reform to the childcare tax-free allowances, and this childcare account is intended in due course to replace childcare vouchers. So the plan will start rolling out to the parents of younger children from April, with the intention that all parents will have been able to sign up to the new accounts by the end of this year. Effectively, it's a top-up of payments that parents make into a national savings and investment account up to 20% of £10,000, so up to £2,000 a year. There's also been some new some new extension to the tax-free childcare available to working parents with an additional 15 hours added there, and qualifying children have been able to get adjustment for free transport is quite limited now on the mileage from school, and this has been extended for certain children. Withdrawing profit from your company. There's a marginal advantage there you can see in terms of taking dividends for 27/18. This applies across the rates, basic rate, higher rate and additional rate. The calculations there ignore the £5,000 exemption. The main thing on the news this morning and listening to all this sort of self-employed trade going in on Radio 2 this morning is the reform of NIC for self-employed. This goes with the planned abolition of the Class 2 for national insurance and local, but this coupled now with an increase in Class 4 national insurance, so the national insurance paid on profit, we'll see an increase of 1% to 10% from April 18 and a further 1% with the charge to 11% from April 19. Doesn't actually mean a reduction in the national insurance for some, where their profits are up to 16,250 in the first year, but after that, then they will see an increase. And coupled with the change we've mentioned already in relation to dividends, reducing from £5,000 to £2,000, the overall aim of this is to produce a better alignment, it said, between the tax and national insurance paid by the employed and self-employed on the same levels of income. Here at some of the other allowances and bands, you'll see the changes there, a small increase in the annual CGT exemption, and what we've mentioned regarding the money purchase allowance pensions, and that's reduced from £10,000 to £4,000. Lifetime, this is coming in without any significant changes. It's aimed particularly at young adults, as it's referred to help them find their first home. Allowances really because the clock is ticking. If you want to elect for the individual section 2014, as far as the lifetime allowance is concerned, an election needs to be made by 5th of April 17, and remember there about reduction the annual allowance to a maximum of £40,000, and the way in which this is adjusted for income over certain limits, with a tapering release bringing the minimum to £10,000. Those rules are the same for 27/18, albeit there will be an adjustment to settle the money purchased down to £4,000 of that allowance. There were some foreign pension changes coming in terms of the percent reduction which has been enjoyed in the past by UK residents. A couple of points to notice really in relation to the qualifying recognised overseas pension schemes, the top of legislation is going to be introduced there, which will require a 25% charge if pension transfers are concerned to QROPs going forward. There are some exemptions still available here, so it's not necessary that everybody is going to suffer this charge, but it's certainly something to pay closer attention to. And as far as UK domiciles are concerned, we were aware again that some changes were coming in from April 17. This has been confirmed, but has been, as in the budget, is that there's going to be a few easements as far as the impact of these rules. So where there was to be a grace period until April 19, people to unravel mixed funds, have previously been capped at funds from 2007-8, but it's now been extended to include funds that were held before 2007-8. And also with regard to the disregard for qualifying interest in relation to certain property held for an offshore entity, this previously been set at 1%, but after consultation, it's been agreed that the disregard can be increased to 5%. To Phil now to have a look at business tax.
Karen. Moving on to the first slide, corporation tax rates. I won't run through the whole slide, but just to say, there are no new announcements on rates yesterday. The rate has dropped to 19% for corporation tax, which is welcome, and we are en route for 17% by 2020, which for those of you who, like me, can remember rates into the 30s, they're now feeling quite low and very attractive. I would just add, as noted on the bottom of the slide there, things that did come up yesterday. On D, there is going to be administrative change to make claims easier, so we look forward to seeing the detail there. And also appropriations to trading stock. There is the election, the 161 election, to hold over a gain or loss when appropriating to stock. It was possible historically to turn what was effectively a chargeable gain into a trading loss. That no longer be possible. Again, I won't run through all the rates on the slide there. They're as expected. As you can see, there is very much a lower rate at which the reductions come onto small property, large property. Sorry, the other way round. And likewise, small properties are benefiting in terms of increases as well. Things that were announced yesterday, because I think we all appreciate there's been quite an uproar about the change to business rates and the hardship it's caused. So that £300 million fund, local authorities can use at their discretion. And there will be more frequent valuations of properties, so we don't have the big steps which have happened this year. And we'll hear more in the autumn budget about those. There's likewise been additional steps announced for hubs and for people coming out of the small property regime. Tax losses, this is something that was pronounced. So we're seeing limits to the rate at which losses brought forward can be used for larger businesses. As we see, there is a bit of a trend here. While the corporation tax rate is coming down, after these reliefs are limited for larger businesses. So effective tax rates are essentially going up for larger businesses. So what's this doing in terms of losses? We're used to losses being utilised when they're brought forward pound for pound. For larger businesses, if you've got over 5 million of profits in a year, you set off your loss brought forward pound for pound up to that 5 million, but it's only 50% after that. So you can end up in a situation where you've got losses brought forward and you're paying tax, which has never been the case. Good news on losses, and this is the case for all businesses, all companies, is that there will no longer be streaming after April 17 for new losses after April 17. So as we used to, a trading loss or an interest loss and various other types being looked at separately and streamed, that will no longer be the case. And also one big change, losses brought forward after April 17 can be set off across a group, not just different types of profits. The would add is there are transitional rules. We're probably going to see a couple of complex years for businesses who've got losses brought forward. Where your pre-17 losses you've still got to stream and treat your post-17 losses differently. But once those old losses are washed through, it will be a much simpler regime and one that allows losses generally to be utilised quicker. So corporate tax roadmap we've all heard about. So as we're aware, there's been a lot going on with BEPS in the background coming through from OECD and the various initiatives within the UK as well. And to touch on a couple of those as we run through, so we've got the multilateral instrument is already out there for individual territories to start signing up to prevent treaty shopping. We've got hybrid mismatches. Then as we can see here, April 17, quite a few changes coming in, and we'll touch on some of those in a bit more detail later in the presentation. Late 17, country-by-country reporting will become relevant. Again, more detail on that for larger businesses. April 18, making tax did hear yesterday, for the very small businesses, i.e. those under 85k turnover, the VAT threshold, April 18 date has been pushed out by a year to April 19. April 19, as you can see, we've then got advancements of quarterly payments for larger businesses with over 20 million taxable profits. So then you can see another relief taken away from larger businesses, cash flow disadvantage to them there. Then finally, April 2020, the rate's right down to 17%, and making tax digital will start being relevant to larger businesses as well. A bit of detail on restricted interest deductions. We're used to a situation where, other than thin capitalisation or worldwide debt cap, we've also had generally interest has been deductible for tax purposes pound for pound in the UK. We're now going to get interest deductions for larger businesses. They've got more than £2 million as a net interest charge. And I stress the word net there, so that's interest payable, less interest receivable. So there's going to be various tests here, which we'll go into a bit more detail on the next slide, where we look at both the UK ratio of interest payable to EBITDA and also the worldwide ratio. Around the flow chart there, the steps you've got to look at. So you start off, you get your taxable numbers by looking at transfer pricing, etc., putting those adjustments through. We then need to aggregate the figures for net interest expense across the group and EBITDA across the group. Then go down to look, does interest expense exceed 2 million in the UK anyway? If it doesn't, you're straight out of this. There's a fixed ratio. Is interest expense in excess of 30% of EBITDA? And the group ratio, where you look at the same test on a group basis. And look at restriction A and B, which we've got on the next slide. So A is broadly saying which is the higher number of 2 million, or the UK restricted EBITDA, or the group restriction. And we look at restriction B, and we look at the lower of 2 million, or the group interest expense. So you can never, of course, get a deduction which is higher than the UK net cost or the global net cost. So there's at the bottom of the slide there, highly geared groups should be preparing now. Of course, it's very relevant to a lot of property groups, a lot of private equity-backed groups, and other global worldwide situations where it's been preferential to put a lot of debt into the UK historically. The stamp holdings exemption, here's a change which is pure good news for us, fortunately. There's an exemption which was brought in 15 years ago, so this is all about a trading group being able to sell a trading subsidiary tax-free. It's been recognised in recent years that we were no longer competitive on a global stage, as there were some very big hurdles to get over for SSE to be available. And the particular tests which have now been removed, as we look at there, the investor company trading condition. So historically it was only a trading group that could sell a trading sub. Now that condition's gone. So say a property investor or someone who's non-trading can sell a trading subsidiary and potentially benefit from this. The investee company trading condition has also been removed for both sales. There's always a condition which was seen as particularly onerous and potentially unfair, as it was a conditional rate relating to whether the company was still trading post-sales. And once you've sold the company, you no longer control it. So that's now gone. Minimum holding period is now only 12 months in 6 years. So you can see what that's really allowing you to do. As long as you allow 10% for a 12-month period, you stagger your disposals over quite a long period and still enjoy the benefit of SSE and the tax-free sale. So this is going to be available to much more businesses going forward. So dot strategy, something else that's going in for the larger business, although, as I mentioned, there will be some subs of worldwide groups who it's relevant to as well. So it's generally companies with projected turnover over 200 million or balance sheet totals over 2 billion. Thing in the tail to look at here, even if you're a much smaller business, a tiny business, but owned by a global group which has turnover over 750 million euros, you do fall into this. Now, it needs to be war and peace, but as we say on the slide there's a few key points you will be expected to publish all around your attitude to risk, your attitude to planning from a tax perspective. You must check annually. December year-end businesses will need to do this by December 17. And we are now seeing a lot of businesses, even those who haven't actually got a statutory requirement to adopt this, choosing to do so, as it's seen as best practice, and of course your customers and indeed HMRC can see what's on the website and form a view as to the type of businesses you are. Digital, just briefly, so we're into this in April 18, so relevant for small businesses. Quarterly reporting will come in from April 18. As we heard yesterday, for very small businesses below the VAT threshold, that was back to April 19. There is a minimum at 10,000, so tiny businesses outside it. Basis accounting will be relevant for small businesses and unincorporated landlords, and various simplified rules will be brought in. At the bottom of the slide there, there's a concern with new initiatives like this, whether HMRC will actually be ready for the extra work that their own initiative will generate. But we are expecting recruitment within HMRC, so there should be an ambition to be. Hopefully there'll be a light touch penalty regime in 18-19 when we move to this. Over to Karen and employment taxes.
Thank you. Start look at the Class 1 National Insurance rates and thresholds. The main change here really is the alignment of the primary and secondary thresholds for national insurance. So we've rid of that slightly frustrating difference of £1 between the two thresholds, and they'll both be aligned at £157 per week to 27.18. We've mentioned again the Class 2 NIC abolition. That's really the most significant change for national. One change with regard to minimum wage is that going forward the national minimum wage and the national living wage will both be reviewed annually on the same date. So we've got rid of this misalignment of October and April review with a catch-up to review both from April 17. A major change that's coming in from April 17 from employers, and the intention of this is to encourage new apprenticeships collected via your payroll return to RTI, and there's effectively a 0.5% charge on your gross pay bill for national insurance purposes. For smaller businesses, there is a levy allowance of £15,000, which effectively means that if your annual pay bill is below £3 million, that you won't have a net levy charge. But the important thing to bear in mind for group companies and connected companies is that you only actually get one £15,000 allowance to share between the companies, although there is some flexibility of how you share it. On the funds will be possible to pay for apprenticeships. Important thing to note here really is the time limit, and that's originally set at 18 months, but has been extended to 24 months. So the oldest funds will start to disappear from your online account at the 24-month period. It's possible now for employers to go in and register and get these online accounts set up for the apprentice levy funds, and with the first contributions being credited to them in May, really employers should be thinking about their future apprenticeship requirements and their opportunity to draw down on these funds. In line with the aim to sort of upskill the workforce, There are also new T levels that proposed introduced, so that's technical training, and that will come in from autumn 19 with a choice of 15 different routes for the 16 to 19-year-old students. As said there, is to put it sort of online with A levels and address some of these skills shortages. But there's also a number of new investments with regard to academic research, or students' loans available for certain doctoral students and degrees, and the launch of an Industrial Strategy Challenge Fund, which sees £270 million of funding for certain research and innovation that's being carried out as well. Another significant change coming in with regard to off-payroll labour affects the public sector from April 17, and the intent is that this should clamp down on what's known as disguised employees. Typically that might be somebody who's working via their own personal service company or one-man company, and public sector bodies where they're making a payment via an intermediary, such as this personal service company, will be required to apply these new deemed employment tests. So if, in the instance of that intermediary, their arrangement with the worker would look like one of employment, then the worker will be regarded as a deemed employee, and that means that the person who's paying the intermediary, that might be the public sector body or maybe an agent who's inserted in that engagement chain, they will be responsible for deducting the PAYE and employer NIC, but also, importantly, they will have to pay employers NIC, and the fees paid under the contract will also act as part of the pay bill for the budget levy. Additional 0.5% charge there on the bottom line. But workers won't actually get the entitlement of employees, so they'll be entitled to statutory payments, for instance. In all the public sector, with this status question, Revenue and Customs launched in the last week their updated online tool. They had a status indicator tool available for some years, but that was restricted and that it wouldn't make a decision. We're looking at sort of IR35 scenarios, personal service companies. So the ESS and Employment Status Service is actually upgraded this tool so that it can now be used for all status scenarios. Again, a change we've gotten to grips with recently that comes in from April 17, or the initial impact of it starts to apply from April 17. I'm aware that salary sacrifice and the advantages of this have been under review for some time, and I think there's been some discussion about sort of how wide-ranging the changes might be. What we have now will be OPRAs, so optional remuneration arrangements, and a new class of benefits, where there's a salary sacrifice or salary exchange arrangement, the tax and employer NIC advantages will be lost going forward, subject to a few exemptions, which we'll look at in a moment. I think what was the surprise with this in the legislation, that rather than just perhaps the additional salary exchange arrangements, which we're all familiar with, that it does include certain cash alternative arrangements. So typically this might be where somebody's had the option to have cash or a company car. And going forward, the intention is that tax and insurance will be on the higher either of that salary or cash foregone and the value of the benefit. But as I said, a few exceptions to the introduction of this, which effectively mean that the rule won't apply until 5th of April 18 unless there's a change, variation or renewal. And there are a few items which are exempted from the new rules, pension contributions being the main one, also childcare, ultra-low emission vehicles, and certain longer-term arrangements where some might enter into a 3 or 4 year contract, typically something like a car that's over 75 grams emissions or living accommodation school fees. There are additional protections for those on an additional basis until April 2021. and a few other changes from April 17. One that's mentioned is that the Met will be publishing guidelines on for employer paying image rights, and that recognises some of the recent court cases that have been in relation to the payments where they're made under separate contractual arrangements. Typically, it will be footballers, and that's what sort of gets the sort of publicity, but and it's sports people who are able to have right payments under these separate arrangements. Also, a few other exemptions. One in relation to cost of legal support. Also mentioned there sort of pension advice. And a couple of changes in terms of to the taxation position. One deals with employer assets that are made available to employees, and changes to have certain discounts and reductions that are calculated for reducing that tax charge, and also to align the dates for making good the cash equivalent benefits, because these varied before on the class of benefits, and there were inconsistencies in the guidelines that the revenue also, so that will be aligned at 6th of July going forward. Points here looking forward a bit further to April 18, and the consultation on termination payments has resulted in a few changes. Significantly with regard to employers' NIC, we'll see a charge in the excess over £30,000 for a qualifying payment in lieu of the existing tax charge, and also all payments in lieu of notice now will become taxable, and that's regardless of whether there's a contractual or non-contractual entitlement. There's also some changes in foreign service relief, which are significant if it's worth taking a further look at if they are to your circumstances. A couple of clarifications in relation to the PAY settlement agreement. Those who are familiar with these will know that they're quite a laborious paper process at the moment, so the annual renewal requirement will be removed, and we'll be moving to a digital process for that from April 18. There's also been an announcement regarding calls for evidence, looking at a number of areas in relation to expenses and benefits. One on the evaluation methodology, and also specifically at employer-provided accommodation. So do Peter to look at property taxes.
Karen. Start on the interest deductions. Phil was talking about these earlier, to make you aware that there is an exemption of public benefit infrastructure. So if you're involved in that, perhaps have a look at that and see whether you fall within that particular exemption. By individuals, I mean, this has been a lot of publicity about this, and it's a gradual removal of higher rate tax relief for interest payments. So at the moment, if you're paying tax of 45%, and you receive £10,000 of rental income, you would get tax relief at 45% if you were paying interest against that. Going forward, that's going to fall away. For a quarter of the interest per year will only attract basic rate relief. It's something you need to be a little bit careful of, because there is a slight quirk in the legislation. When 2021, £1,000 in my example would be taxed at 45%. You get a tax credit for the interest deduction, which it could mean you take you over from one threshold into another. So for instance, if you were just under the 100,000 threshold, you could effectively rate of 60%, or it could take you over into 150. So just look out for that. It won't apply to furnished holiday lets, and won't apply to properties held by companies. I've got many landlords looking at incorporation, just to look at that, but it can be done very tax efficiently. Obviously, we won't have to discuss that. So a typical structure for a non-domicile is to have a trust offshore, which in turn owns a company, and the company in turn owns a property you may occupy yourself. And that's very efficient for inheritance tax, capital gains tax, etc. From 2017, April 17 onwards, they will effectively get caught for inheritance tax. So either form part of your estate or result in exit charges if it's coming out of the trust. We've got many clients to look at the structures at the moment to see whether they can break them in one way or another. Below dwellings, that's sort of an extension of what we were talking about before. This is where you've got a property in a company that's being used by you personally, so residential property, and you've effectively, in order to take advantage of that, you have to pay an annual tax charge. You'll see it at 500,000 to $1 million. You'll be paying £3,500. If you've got a property worth 20 million, it's £220,350 a year. So they've gone up slightly at the top end. Stamp tax, these figures have remained the same, and there was a number of calls to see whether they could give some benefit, perhaps to first-time buyers, sort of fallen on deaf ears. So we've got the 3% extra where you're buying a second residential property, either a buy-to-let, perhaps a second home to live in. Property, non-residential property, the rates again stay the same. Taxes. Rates have gone up. Duties on beer, cider, wine, etc. has gone up by 4%. I think it amounts to about 2p on a pint of beer. And then the VAT rate, the UK rate has stayed the same at 20%. You see this rate in the EU is 17% with Luxembourg. Hungary have quite a high rate there at 27%. The average is 21.46, so we're slightly below that. Also, they announced that the registration threshold for where you need to be VAT registered has gone to 85,000, and the rate you deregister is 83,000. Those that are involved in the flat rate scheme, cash or annual accounting schemes, the limits remain unchanged. There are a number of interesting changes that have come about in the future. So from the 1st of August, the Chancellor announced that you charge VAT on calls outside the EU. At the moment, that's not the case. So he wants to collect his VAT there. And also, he's looking at overseas traders selling goods through online marketplaces to the UK customers. At the moment, a number of those aren't paying VAT, and he's looking at the split payment method to be able to recover that VAT. And finally, with regard to combating trader fraud, this is in the construction industry. This is where typically people are raising invoices for employee charges of VAT, and then when you go to find that, the people that charge the VAT, they're not around anymore. So what they need to do is introduce what they call a reverse charge mechanism. It would mean it would be a paper exercise on your VAT return, and the people in question wouldn't receive the cash. So the customers would be out of pocket, but there's consultation on that. Other tax announcements: insurance premium tax is raised from 12% from the 1st of June, and soft drinks industry levy, which has been talked about a lot. The levy will be 18% on a litre at 5% sugar threshold, 25p above. They were talking about raising £1 billion from this. We're going to go to school sports and healthy living. He thinks that it's making a difference because the sugar content is coming down, so arguably it is having an impact.
Right, enforcement and HMRC powers. So, requiring correct tax returns. A couple of slides relate to offshore affairs. You'll be aware that HMRC has had quite a push in recent years trying to get people's offshore affairs into a more transparent place so they can get places and appropriate tax take from them. This first point is all about the penalties, etc., which will come in for people who don't correct tax returns by September 2018. So for years 2015, 16 and earlier, you have a window to make an appropriate disclosure to HMRC and file appropriate returns. We strongly recommend people do take advice on this area if you've anything that you think hasn't been disclosed. As you see at the bottom of the slide there, prosecution is a possibility, some fairly steep penalties, and as we're seeing more commonly, potential naming and shaming on HMRC website as well. So more on compliance, but this is very much the forward-looking slide. So this is all about your obligation to notify HMRC if you have sort of offshore income or gain going forward. Likewise, there is a similar consultation underway for advisors who advise clients on offshore structures, and again, a fairly stiff penalty regime for advisors as well. So looking forward, you need to think very, very carefully if entering into anything with an offshore implication, an offshore aspect, what you need to be notifying HMRC about. And again, please be well advised in that regard. So coming in, as you said, in a few days' time. What's it all about? This isn't offshore anymore. This is looking at principally UK arrangements. And tax avoidance, I just want to say, I mean, here we're not talking about routine stuff, you know, slightly aggressive R&D claim or capital allowances claim. This is the sort of thing that the reasonable man in the street would think feels aggressive. So the various things you might think about: have you had to sign a non-disclosure agreement? Have you paid a premium fee? Does it feel aggressive? Is it too good to be true? And if it is in this day and age, it probably isn't right. It probably is tax avoidance. You can see here, there's a serial tax avoidance regime. As it suggests, it's all about stopping people doing this on a routine basis. Once you're into this regime, you're stuck in it for 5 years. Have to give fairly onerous information to HMRC on an annual basis. Likewise, you're then exposed to additional penalties if you're involved in any schemes that is defeated. If you've been involved in any avoidance schemes, then you should be thinking pre-6th of April whether you need to notify HMRC of anything or try and work out the way out of the scheme. So again, please be well advised. That serial tax avoidance, this is just any other tax avoidance arrangement, and again, looking forward, a change that's happened here is into how you defend yourself from penalties if you're involved in tax avoidance. Historically, it seemed reasonable to say, well, I was advised by the law firm, the accountant who sold me the scheme. Going forward, that wouldn't be appropriate. The only way you're going to defend yourself is if you've actually taken some independent advice and someone who's not the person who sold you the scheme or someone connected with that person. Otherwise, again, as you can see on the slide, there's fairly stiff penalties there. Tax enclosure rules. We're seeing change here in terms of partial closure notices coming in. It's been the case that if you've had inquiries into a range of areas within your company's affairs, your inquiry has remained open until the very last issues were closed off. And of course, that could take years in the case of complex inquiries. Now we're going to see partial closure notices, so these could be issued as the individual areas are confirmed and closed down. And the impact of that, from HMRC's perspective, that means they're then in a position to start charging you the tax or indeed the penalties, etc., at a much earlier date from the time that initial partial closure notice is issued. Other hidden economy. So again, this is HMRC wanting more transparency. What activity is going on that they're unaware of and they want to tax? So they're going to be able to go to other areas to try and get information, such as check cashers. Also, HMRC are now going to be able to defer you obtaining licenses to provide various services, etc., until you've registered for tax. And on the slide there's going to be increased monitoring for repeat offenders. So very much a push from HMRC, how can they get more transparency? Enforcement. As I said, slide, new penalties for those participating in VAT fraud. Disclosure regime, as we're seeing across the taxes, is very much broadening, and indirect taxes generally will be aligned with DAS. And changing rules, enhanced rules for HMRC to be able to search premises, vehicles, etc., regarding VAT. So we're seeing quite a lot there in terms of VAT Thank you.
Well, we had a couple of questions through, but they're very specific for individuals rather than related to the budget. So what I was proposing was to sort of call it a day there. I'd like to thank you all, thank the presenters for also for joining us. And as I said earlier, the webinar will be posted on our YouTube channel, and also will be more detailed analysis on our website, bdo.co.uk. Please feel free to contact me or use your BDO contact if you need further advice. Once again, thank you very much for joining us, and I hope you have a good day.